But is this criticism fair? Supporters of the renovation point out that the buildings are nearly a century old, that much of the work is focused on crucial upgrades to security, technology, and structural safety, and that construction costs everywhere have soared since the inflation shocks of 2021 and 2022. Underground construction, advanced cybersecurity systems, and compliance with modern building codes all add to the bill. Still, the optics of such a vast expense at a time when millions of Americans are struggling with rising prices have fueled a heated public debate.
Within Trump's own administration, there is division. Treasury Secretary Scott Bessent, who has been floated by Trump as a possible successor to Powell, has publicly defended the Fed chair, saying, "There's nothing that tells me that he should step down right now. He's been a good public servant." This split reveals the complexity of the issue, balancing the need for expert management of the economy with the demand for political oversight.
First, if Jerome Powell and the Fed stand their ground, refusing to yield to presidential pressure, markets might initially breathe a sigh of relief. Investors crave predictability and the assurance that monetary policy will not be dictated by shifting political winds. However, the very public nature of this showdown could still shake international confidence. Imagine waking up in London, Tokyo, or Berlin to headlines declaring that the United States is at war with itself over the future of its financial system. Even the perception of instability can trigger capital flight, volatility in exchange rates, and a rise in the cost of borrowing for American businesses and the government. Second, if Powell or his successors cave to political demands and begin slashing rates to please the White House, the precedent could be devastating. History offers chilling case studies. In Turkey, repeated political interference with the central bank led to runaway inflation, a collapsing currency, and a dramatic loss of investor trust. Argentina, too, has suffered recurring crises driven by government meddling in monetary policy. Crises that have wiped out savings and plunged millions into poverty. The lesson? Short-term political gain often comes at the expense of long-term prosperity. Third, this controversy is sparking a national and international conversation about how the Federal Reserve operates. Should its meetings be more transparent? Should its decisions be subject to greater oversight? Should the public have more of a voice in choosing its leaders? In an era of social media and 24-hour news cycles, the days of the Fed operating quietly behind closed doors may be coming to an end. But let's not lose sight of the personal stakes. For ordinary Americans, this battle between the White House and the Fed is not just a distant chess game. It touches every corner of daily life. If the Fed bends to political pressure and slashes interest rates to boost the economy ahead of an election, you might enjoy lower mortgage rates or cheaper car loans in the short run. But the long-term risks are real. Higher inflation, eroded purchasing power, and the possibility of a financial crisis. On the flip side, if the Fed stands pat and keeps rates high to control inflation, borrowing may become more expensive, economic growth could slow, and jobs could be harder to find. But your paycheck and savings might hold their value better over time. Here's a fascinating historical footnote. In more than 100 years, only a tiny handful of presidents have ever set foot inside the Federal Reserve's headquarters. Trump's visit, marking just the fourth such occasion, is a signal to the world that something truly extraordinary is underway. It is a gesture loaded with symbolism and risk, a reminder that even the oldest traditions can be upended in the blink of an eye. Let's take a moment to zoom out and consider the global context. The Fed's independence is not just an American ideal. It is a model that other countries have tried, with varying degrees of success, to emulate. The European Central Bank, the Bank of England, the Bank of Japan, and others all grapple with the tension between democratic accountability and expert-driven decision-making. When the United States wavers in its commitment to central bank independence, it sends shockwaves through these institutions as well. Will other nations feel emboldened to interfere with their own central banks? Will the global rules-based financial order unravel? Moreover, the credibility of the United States dollar as the world's reserve currency rests on the perception that America's economic institutions are stable, predictable, and above political gamesmanship.
If investors start to believe that the Fed is just another tool of the White House, they may seek alternatives, from gold and cryptocurrencies to foreign currencies like the euro, the yen, or even the Chinese yuan. That shift could raise borrowing costs, trigger inflation, and weaken America's influence on the world stage. Let's not overlook the political theater at play. Trump's visit to the Fed is both a calculated risk and a masterstroke of media strategy. By making the conflict personal, by turning the spotlight on the Fed's renovation project, and by framing the debate in terms of waste and accountability, he is rallying his supporters and putting his opponents on the defensive. Yet this approach also courts danger. Financial markets are famously allergic to uncertainty, and a misstep could erase trillions of dollars from global stock markets overnight. Expert voices are divided. Some, like former Fed Chair Janet Yellen, warn that any move to undermine central bank independence could set off a chain reaction, eroding confidence and making it much harder to fight the next crisis. Others argue that greater transparency and accountability are long overdue, and that the Fed must adapt to the demands of a more democratic age. As the White House and the Federal Reserve stare each other down, several scenarios could unfold in the coming months. The standoff could harden, with both sides refusing to budge. This could lead to a prolonged period of uncertainty, with markets swinging wildly as each new headline emerges. The Fed could offer a modest rate cut as a compromise, hoping to appease political pressures without sacrificing its credibility. But such a move might be seen as weakness, encouraging future interference. Congress could step in, holding hearings on the Fed's renovation expenses, its decision-making processes, or even considering legislation to redefine its mandate. This could reshape the entire architecture of American monetary policy. International bodies, like the International Monetary Fund or the World Bank, could issue warnings about the dangers of politicizing central banks, adding fuel to the debate. In the meantime, ordinary Americans are left to navigate a landscape of uncertainty. Should you refinance your mortgage? Should you lock in a fixed-rate loan before rates potentially rise or fall? Should you be worried about the security of your retirement savings, your 401k, or your pension? Here's some practical advice. Stay informed, be cautious about big financial decisions during periods of volatility, and diversify your investments. Remember, short-term political dramas often create noise, but the fundamentals, sound budgeting, prudent saving, and diversified investments remain your best defense against uncertainty. If you are a business owner, now is the time to stress test your business model. How would your company cope if interest rates suddenly spiked or if consumer demand slowed? What steps can you take to build resilience, strengthen your balance sheet, and plan for multiple scenarios? For investors, watch not just the headlines, but the data. Keep an eye on inflation reports, employment numbers, and corporate earnings. Pay attention to how global markets react, not just in New York, but in London, Frankfurt, Hong Kong,